Okay, thank you everyone for joining our Public Banking 101 session with the Friends of the Public Bank East Bay. Today we have Graham Seal here to discuss risk management. And on the agenda to start will be what is risk? And then discussions on risk appetite, assessing and measuring risk, options for managing risk, categories of banking risks, and enterprise risk management. If you were not here for the last Public Banking 101 session, Graham will be presenting a PowerPoint slide deck, and please feel free to unmute yourself if you have any questions. And if you would rather just post them in the chat, you can do that as well. And I will be watching the chat and let Graham know as questions come up. And then depending on time at the end, we can also have some open time for discussion and questions at that point as well. So Graham, are you ready to take it away?
Yes, I am. Did you set me up to be able to share?
Yes.
Good. Oh yeah, there we go. Yes. Thank you, Zoe. Welcome everybody. As I was saying a few minutes ago, actually I applaud you all for turning up to what sounds like a really boring topic. It's, as Zoe said, it's not very sexy. It is probably the single most important topic in banking. And if we are going to participate in setting up any kind of bank, and in our case, obviously the public bank, we have to understand risk management. And that's going to, you'll see some of what that involves. There's certainly more to it than meets the eye. The other thing I was going to say, last session, I really appreciated the number and level and intelligence behind the questions that we had last time. And I look forward to the same kind of dialogue. So I will just pause periodically to see if there are any questions. If they're not, it's fine. Zoe, you can try and remind me if necessary that probably we need to push on. So, going into this, three statements here, and in my mind, they underlie everything to do with risk management in banking. The first one comes as a surprise to a lot of people until they think about it, which is that banks are not in the business of managing money. Banks are in the business of managing risk. And I'll explain that a bit further later on. But once you understand that, you realize how risk management has to be the most important topic. Money is not the most important topic to banks. The second thing is risk management is not the same as risk avoidance. In fact, the worst banking managers are the ones who avoid risk. That's a guarantee for failure. Banks make money because they take risk. If they don't take risk, they lose money. The third thing is risk management. Management is the key word here. It's all about understanding risk of all its different kinds, and we'll look at some of that. And with that understanding, with all the data necessary, and with all the reasonable expectations of what might happen, you make well-informed business decisions. The vast majority of managers don't take the trouble to understand their risk. And I'm talking about banking managers in my experience. And they make kind of seat of the pants business decisions without really understanding the risks that they're taking or avoiding. So, so just important quotes, those. We're going to talk about what risk is. It's obvious and not obvious. And then this idea of risk appetite, this is really important. And risk appetite kind of starts the discussion and it will end the discussion to some degree as well. We'll look at some of the different dimensions of risk. What's involved in assessing risk? It's one thing to say, you make good business decisions when you understand the risk, but what does it mean to understand it? Something bad might happen. Well, so what? How likely is it to happen? What will happen if it does? That kind of thing. We'll look at some different options for managing risk. It's not all about whether I take the risk or don't take the risk. There's a lot more to it than that. Then we'll talk about some categories of risk, particularly in the context of banking, And you'll have heard some of the terms, but it's important to understand that different categories of risk are managed in different ways. And then we'll look at the big picture, how a bank as a whole manages its entire risk environment, known as enterprise risk management, not surprisingly. A lot of smaller banks don't have any concept of enterprise risk management, and it gets them in trouble. Even for a bank as small relatively as the East Bay Public Bank is going to be, some concept of enterprise risk management is going to be important. So these are all things we'll revisit in the context of our bank, but basics. All of life is about risk. Obvious statement, life is uncertain. We don't know what's actually going to happen from anything we do. We have a pretty good idea of what we think is likely to happen, but there's always a risk that something different will happen. It's also, of course, very risky not to take action. The obvious example is it's risky crossing the road, but it's also risky to cross the road and then stop in the middle and not doing anything. That's actually riskier than keeping going to the other side. It's risky not wearing a mask. We have different perceptions of how risky that is. There are some who think it's only marginally risky. There are some who think it's very risky and can't bear the thought of being outside without a mask. So we have different ideas of what the risks are. And indeed, to some of us, it's much riskier than it is to others, depending on our underlying health conditions and so on. Starting a new relationship is one of the riskiest things we do, isn't it? Because there's a significant probability that we'll get hurt. Even if the relationship really works, there's a really big probability we'll get hurt. And hurt is an unacceptable or an undesirable outcome from actions we've taken. As children, we all learned that disobeying a parent was a risky thing. So we learn risk very, very young. And very young children make decisions around obedience or disobedience in part through probably semi-conscious assessments of risk. How likely is it that I'll get caught? If I do get caught, what's going to happen to me? And is what I want to do worth it? That's a classic risk management decision. And so all of life is about risk. So risk is present anytime undesired outcomes may occur that could negatively impact our business when we talk about banking, or our life. Or to put it another way, risk is present all the time. Being completely risk averse is actually impossible. Becoming a reclusive hermit by no means eliminates risk. There is no way to do it. The only way to eliminate risk is to not be alive. So, let's talk about financial risk more specifically. And again, on a personal level, we have lots of risk around our money. So for example, if we keep lots of cash, it might get stolen, might get lost in a fire or flood. Storing cash under the mattress, while it may deprive the banks of some revenue we don't want to give them, it's actually generally not a very smart idea if there's much of it, because it's so risky. One of the reasons we deposit money in the bank is so that they take over the management of the risk, particularly with deposit guarantees. So if they lose our money, we'll still get it back because of FDIC guarantees. If we have investments, they may go down in value. If we lose our job or are sick or disabled or past the age of being able to effectively earn money, those are all income-related risks, as the picture shows. Maybe we lend money to a friend and we don't get it back. That's a double risk, actually, double outcome. Number one, we're out the amount of money that we have lost. And number two, we've damaged a friendship. So there's different kinds of risk in everything we do. Not even our financial decisions don't necessarily just have financial outcomes. We borrow money and can't repay it. There's a risk in that as well. the implications of not repaying our debt can be very substantial. We could lose our house, for example. And then things happen in our lives that we have no way of predicting whether they will or won't happen. We have a huge medical bill, our house is flooded, or we have a fire, we get caught in an earthquake. All of these kinds of risks that we can't control. They're completely external to us, and yet we somehow have to manage them. And that's where we come to risk appetite. There's this article I came across where somebody did a survey asking 3,000 Americans, not a particularly big sample size, but it makes sense, 3,000 Americans between the ages of 25 and 70, how they feel about financial risk. And they're asking a number of different questions to kind of arrive at this continuum. But some people are right down on the risk avoider level. 42% are not willing to take any risk. They think they're not willing to take any risk. As we've discussed, they're taking risks all the time. But wherever they can avoid a risk, they'll do so, because risk is associated with loss or uncertainty. It's a negative. Their investments will be very low risk. They'll invest in government securities or whatever rather than in the stock market. They're less likely to take personal risks. They're probably not going skydiving. They are more likely to stay in a job than to try a new one. Then there are those who will take risks, but they're very careful about it. 89% of people actually, to some degree, and this includes some of the risk avoiders, are prepared to take a risk if they can do all the research and really get a sense of what the implications are, and then take precautions. For example, take out insurance or go very carefully into whatever they're doing. They protect their assets by diversifying investments. Not a bad idea at all. They get health insurance, that kind of thing. And then they can sort of live easy. Risk managers go further than that. And they start to say, well, risk is a good thing because risk is actually opportunity. Risk is, if we don't take a risk, we'll never accomplish anything. On the other hand, if we do take risks, even though sometimes it may go wrong, the benefits will outweigh the losses. And so risk managers are the ones who understand the opportunities open to them and the implications. If they're making aggressive investments with part of their portfolio, for example, they understand what the implications of that are, that there could be some loss. And so they'll ask themselves the questions, what would happen if I lost that? Can I manage? If so, it may be worth taking the risk and hopefully gaining a great deal more money than I would if I invested in safe investments. And then the risk embracers are the ones who get an adrenaline rush. They associate risk not just with opportunity, but also with excitement. They'll take risks in any aspect of life. If a new job looks like fun, it has potentially high income, it just doesn't look very stable, they're going to take the risk. They're not too worried about it. They'll go for it. They're the ones who just love to, go back to the previous slide, couple of slides. They're the ones who do the tightrope or jump from the high cliff. They're not me, and they may or may not be you. That's the thing. We're all really different. Companies are different too. So just as personal risk appetite varies by personality, time of life obviously is a factor, the ability to tolerate bad outcomes and the understanding of risk. Companies, banks, governments all also have a risk appetite. There's risks they'll take, there's risks they won't take. Often this risk appetite is more about corporate culture than it is about really understanding risk and making conscious decisions. That's one of the biggest problems. Again, historically, banks have not understood this. And bank leadership, especially bank boards, who have the biggest responsibility for this, haven't understood how very significant decisions about risk appetite and how then to use that risk appetite are going to be for the future effectiveness of the bank. We'll come back to that, and in particular the role of the board, of senior management, of junior management, and so on. So risk appetite is often implied, and it's often kind of a default. You discover the risk appetite after the decisions have been made, but nobody really tracks it. One of the results of that is you may have multiple loan departments, all of which are making risky decisions. And in aggregate, the risk is unacceptable. If there's an understanding of the overall appetite for risk, then maybe one or two types of loan could be more risky than others because they'll tend to raise more money. But it has to be managed. So I'm going to stop here. Any questions?
Yeah, Graham, this is Debbie. I have two questions, one of which is pretty lightweight, which is, do you know the work of Bruce Schneier? His field is cryptography, but particularly after 9/11, he did a great deal of work on how bad humans are at evaluating risk.
Yeah.
And
yeah.
one of his examples is how much more afraid we are of flying than driving.
Yes.
Yes.
Great example. Yes.
Or how much more afraid we are of terrorists than the police, right? So I just want to throw his name into the mix because I think his work is interesting. But my real question is, how does invisible risk play into this? And the risk of what you don't do, right? Particularly in the case of both banks and governments. I think that's a very big issue.
Well, I think there's two kinds of invisible risk, actually. One is, yes, the risk of the things, the risk of inaction, which is very substantial, and it's pervades all of business and certainly all of banking and all of government. It's if risk is being appropriately managed, the risk of inaction can be understood. And the implications taken into account when business decisions are being made. If it's not being properly managed, then half the time we have no idea, even years later, what the effect of that inaction was. So that's a really great question. The other kind of invisible risk is the risk we don't know about. For all we know, there may be a legitimate risk that excess cosmic radiation is going to, greatly exacerbate climate change, and we should all be making some other decisions. I'm not suggesting that's the case, by the way. I've certainly never seen that theory, but the point is there are things that are just so beyond us that we can't understand them. To some degree, we kind of have a kind of risk management that says what happens if some unspecified disaster occurs? How will we respond? And we do the best thing we can to have some kind of response plan, even if we don't know the exact nature of the risk.
We have another question in the chat, and I'm not sure if this is going to be answered later, but it is, what risk profile would you consider city and county and state treasurers and or finance officers to have or should have?
I'm really not qualified to answer that, actually, because I don't know enough about local government. I mean, I have my personal perceptions on both halves of that question, but I'm not sure they're very valuable. Others on this call know much better than I do, actually. And I'd be, not necessarily now, but I'll be interested in the answer. I think I'm going to learn more about that as time goes on. Let's talk about how you assess risk. And there's kind of a standard methodology that should be used and isn't necessarily. There are just some basic elements of risk. Some risk management is much more complex than this, by the way, but this is the basic. First of all, we're talking in terms of an event. So a risk is the possibility that something is going to happen. And that something could take a variety of different forms. And so the risk event is a clear description of what it is we're trying to manage. It has to be precise and well-defined. For example, the risk may be that a low-income housing construction loan that we make may default. Now, actually, that can be drilled down further because there's lots of reasons for default. When in the life of the loan is it defaulting and so on. So it's a bit more nuanced than that, but that's the basic idea of it. So we have this event. The second thing then is how likely is it that this event will occur? So usually this kind of risk is managed in the aggregate. And what we would say is we've got a portfolio of similar kinds of loans, just again, using lending as an example. I'm going to use lending as an example quite a bit because that's the primary activity of smaller banks on the whole. So the likelihood of occurrence, it starts out anyway as the probability of the event occurring within the whole population. So how often does it occur within the population and within the time frame that we're looking at? So we're going to look at history to answer that. And that's something that banks are pretty good at. We're going to look at what we know may occur in the future, changing economic circumstances, what we know about the kind of organization that we're lending to, and the characteristics of that organization and the sort of subpopulations and how they behave, all sorts of things like that. But what we want to do is come out with something like a percentage. So we might say there is a 3% probability of default within the first year. And what that means is not anything for a specific loan, but it means over the whole population, it's going to average out at something like that. And then there's a population that even beyond that first year, which is probably the most dangerous year, but even beyond that point, in total, 5% will default. So that gives an idea of what it is we have to manage and the scale of what we have to manage. But then the next question is, what happens if this event occurs? What is the financial impact or the intangible impact? We'll come to that later. But in the case of a loan, it's mostly the financial impact that we would look at. So we might say, if we haven't taken any precautions, we might lose our principal. And then now in the case of an individual loan, we would say, it's the amount we're lending. In the case of a population of loans, a whole portfolio, and we have to analyze whole portfolios, then maybe the average loan size is 1.5 million. That's purely arbitrary. And so that's the average amount. So we would say within a portfolio, if we've given these percentages, if we've got 100 loans in the portfolio of an average size of 1.5 million, and we think 5% of them will default within their lifetime, then we have do the math, $750,000 expected loss on that portfolio. No, $7.5 million, dollar loss on that $150 million portfolio. That's meaningful and has to be accounted for, as a matter of fact. We'll come back to that. The last thing, which is often forgotten, is what's the likelihood that we'll know early enough to do something about it, that this risk event may be coming about? So what are the advanced warning signs that may allow mitigation of impacts? I'll give you a life example of that. A scan reveals a spot on a lung. Okay, it's an early warning sign. And there are things that can be done. A biopsy can be done if necessary. Radiation or chemotherapy treatment can be done early enough to make it go away and prevent the obvious long-term outcome that we'd be concerned about. 40 odd years ago, when my mother had lung cancer, there was none of that. And so there was no timely detection that was available. And so you see what I'm saying. It's important to understand whether a risk event is something that we can project early enough that we might be able to do something about it. Now, what we do about it is something we'll come to in a bit. So a good example with lending is a borrower starts missing their payments. Immediately we know there's a problem. And so immediately we're going to go in and start managing that situation, working with the borrower. And it's always should be working with the borrower. And we all know that far too much of the time it's working against the borrower. And that's one of the biggest complaints about banks, and it's legitimate. There's a lot of reasons for it, but we don't need to go into it. The fact is, it doesn't help in the long run. So, maybe there's restructuring that's appropriate, maybe changing the terms of the loan, maybe any number of possibilities. And it may be, in fact, that project management is an issue, and we work with the construction company to get some help so that they can continue, whatever it is. Those are the four main elements. One area of risk that works a little bit differently, it's very similar in a way, is cybersecurity or information security, data privacy, data breaches, all of that kind of stuff that all comes under cybersecurity. And the terms used there are vulnerabilities and threats, because generally a cybersecurity risk event has some weakness in the extraordinarily complex and ever-changing technology that a bank or any organization is using. And they all have weaknesses. There's no such thing as bug-free software. There is no such thing as a perfectly secure information security perimeter, much as technologists might like to say there are. So they all have vulnerabilities. And so the key is to identify those vulnerabilities through, there's all sorts of different techniques for testing, checking processes and so on. And some of the vulnerabilities are very technical in nature, but some of them are very straightforward. Employee password management. Do we have employees who share passwords? Do we enforce strength of password to the extent that it's going to be really difficult for somebody to guess an employee's password if they know a bit about them? That kind of thing. So that's really basic. It's horrifying how many companies have no interest in this, just don't enforce password management. Probably horrifying how many of us actually don't manage our personal passwords very well as well. I'd probably get a C. I don't know about you, but some of that is to do with risk appetite and a risk management thing. How much is actually at stake? So there are vulnerabilities out there. We need to try and understand them. There are also threats. There are bad actors. There are accidents. There are unexpected events that could take advantage of a vulnerability and have negative impacts. The most obvious one, of course, are the bad actors, the hackers, the ransomware providers. Bits of software are certainly threats, and I'm talking about worms and the like. So, for example, then, if employee password management is really poor, and there is another vulnerability that allows somebody to get in to find user IDs and so on, the bad actors, in fact, either may be able to get the passwords and decrypt them, or may be able to guess the passwords and then expose private data. or initiate fraudulent transactions and so on. I mean, obviously there's many things within this category, but I'm just trying to give an idea of the main elements of cybersecurity risk and the main elements of more general risk. Questions? Okay. A bit more on measuring risk. Most risk measurement, apart from credit risk, is done in a only moderately useful way by talking about relative risk, especially when carrying out major complex projects. Project risk is often done in this way. So we can say we've got this complex project. We've got 6 people working on it. One of them has special expertise. So one of the risks might be the person with special expertise gets sick. Another one might be somebody gets sick of the rest of the team. What's the probability of that, and what impact is it going to have? It's going to delay the project, especially in the first case. So, so in that example, the impact, the probability of the main person getting sick may be low if they're fit and healthy, but the impact may be high. In the other case, if we've got a number of people, the probability of one of them getting sick actually may be high, but the impact may be low because their workload can be absorbed by the others. So, I mean, that's a fairly trivial example, but it's the kind of thing that happens. What people do then is, so they'll look at the likelihood and the impact, likelihood of something happening and the impact if it does happen. And they'll give each of those high, medium, or low, or maybe a finer scale. And then they'll prioritize those risks and put effort and, if necessary, money into addressing those risks so that they can protect their outcomes a little bit more. So it's a bit subjective. Well, it's very subjective, actually. And it's also very common. Quantifiable risk is where you define an expected loss. This is probabilistic. All risk is probabilistic, right? Because we don't know. If we know something's going to happen, then it's not a risk. And if we know something's not going to happen, it's not a risk. So in between 0 and 1 is the whole range of probabilities. We also potentially can assess the financial impact of something bad happening. And it's surprising how often you can do that and how often it's not done, because it takes work and it takes some very careful research. It takes very good historical data, and that's often missing. And it takes sometimes pretty good data analytics as well. It gets quite complex. But the idea, so if we've got a 5, I used a similar example to this earlier. I actually did this. We've got a pool of similar loans, and 5% of them, there's a 5% chance of any one of them defaulting. Then over the whole pool of loans, then with a $50 million pool size, we have 5% times $50 million, or $2.5 million as the risk. As the expected loss. So when we've got a portfolio like that, where we can say we expect to lose 2.5 million, actually under some circumstances, we'll write down the value of the loan book on our balance sheet. And we'll accept that loss as on our profit and loss statement. And there are all sorts of rules around how to do that. And it's not done in this way. But the point is, we can't assume if we have $50 million worth of loans that that's worth $50 million to us, because it's not. It's worth less than that. And so the difference has to be made up through income. And that's one of the reasons we charge interest. One of the biggest. For a bank that is charging moderate and reasonable amounts of interest, that's actually a big component of it. And that's why low risk loans should attract lower interest rates. And they don't necessarily. That's where, that's where the question earlier on comes in. If you look at two identically performing populations with identical types of loans, but one is in a red line district where loans are not as available, and where underwriting decisions include bias, then actually the loan in the red line district is going to be more expensive, and it shouldn't be. There's absolutely no excuse for it. So that's one of the areas of change that needs to occur, and has needed to occur obviously ever since banking started. The third kind of risk is the hardest one, where you just can't quantify it. And so here's an example. If a serious data breach makes front page news, and we always used to say in banking, the worst thing that can happen to us is to be celebrated on the front page of the Wall Street Journal. It's almost always bad news. And when that happens, it damages confidence in the bank. All sorts of things that can happen, and some of them could be quantifiable. But for example, our access to loan capital may dry up because confidence in our ability to repay it may have gone. So now we may not be able to lend so much. We may have a run on deposits, which would be irrational because the deposits are insured, or at least up to a decent number. But it can still happen. We certainly would see increased compliance oversight. The regulators would be all over us, and that is very expensive. The manpower required when you are heavily regulated, heavily overseen, is it's mind-boggling sometimes. And then we also have to move staffing from whatever they were supposed to be doing to focus on remediation of the vulnerabilities that led to the data breach, and to improve our detection capabilities to find vulnerabilities like that. So it's something like that data breach. The other thing that's sometimes talked about is that a public company's stock price takes a hit. And I've often seen headlines that say, $50 billion wiped off the value of Citibank after their data breach. And then people go around saying that data breach cost Citibank $50 billion. Well, that's absolute nonsense, because the day after that, as a little more rationality enters the market, people say, well, how bad was it really? And they start buying back, and the actual loss of value of the company is, over a period of time, is negligible. So that's the kind of risk that you'll hear people talk about that I actually mostly, although not entirely, discount, except in the most extreme cases.
We have two questions in the chat. The first one is there a form or metric or an assessment that we can use for potential CEO and C-level employees to assess their risk management abilities?
That is a really good question. I don't know. I think that's worth researching. There may be. I think it's a matter of in interviewing. I think it's asking the right questions, and more to the point, hearing how they're answered. You kind of get a feel, because this isn't about technique. This is about understanding. It's about getting a risk management culture, particularly with a CEO, or a chief risk officer. They're the ones who are going to drive the risk culture of the organization. And that's from the very top to the very bottom. The board also has a great deal to do with that. So in assessing potential board members, the exact same question applies. You need at least a couple of board members who really understand risk. And then your other board members need to understand it well enough to trust those who really, have deep experience in managing risk at a very senior level. And that's down the road a little bit. But so I don't know whether there are any sort of like automated assessment tools and so on. But it is a great question, because that should be a very important part of the interviewing process, of the selection process.
Thank you. And our second question is, how do federal guarantees, for example, home loans, come into play here? Would they be considered completely risk-free for banks?
I'm coming to that. Great question. So let me answer that in a couple of slides' time, because actually they're ways of addressing risk.
Okay.
So, but generally, I mean, the general assumption is that a government, government borrowing certainly would be considered, especially federal government borrowing, is considered virtually risk-free. Whether it is another question. So I've got to push on. I've just noticed we've only got about 15 minutes left. So I've been going a bit too slowly. Categories of risk. The risks get categorized in all sorts of different ways, but I just wanted to give you a sense of the variety. So credit risk is kind of obvious. When we lend money to people in some form or other, then there's a risk that we won't get the money back. So they may be loans, they may be lines of credit, they may be guarantees that we make on somebody else's behalf, or implied guarantees. Then there's all sorts of market instruments and so on that have credit risk. Some forms of payment even have a form of credit risk. So that's that area. Second one is market risk. When some kind of market activity, and it might be the impact of changing interest rates, or exchange rates, or value of underlying securities, which might form collateral, that would be considered more market risk. For a public bank, there's not so much of this, in that they're not engaged actively in financial markets, but they are definitely impacted by them. And certainly interest rate changes involve a considerable amount of risk. That's going to be the big one. Operational risk sometimes really just covers all other kinds of risk. So if it's not credit risk and it's not market risk, then you could argue it's operational risk. People have moved away from that now and tend to break it down a bit more. But all kinds of technology risk, we talked about some of those, cybersecurity, operations risk, where procedures just aren't strong enough, where people can make errors and that not be detected or checked, where regulations aren't being followed because of procedural errors, that kind of thing. Also on the operations risk side is insider fraud. And most fraud is insider fraud. I don't know if you're aware of that. Most bank fraud, I think it's like something like 80% is actually committed by insiders, not by outsiders. And more work seems to go into the outsider vulnerabilities than the insider. But compliance risk is, as you've seen from the headlines, actually is a pretty big ticket item. The big banks that have failed to meet money laundering requirements, anti-money laundering requirements, have experienced massive fines in the billions and even tens of billions of dollars. And smaller banks obviously don't get those kinds of fines, but smaller banks have to worry about that kind of risk as well. And there's a lot of work goes into addressing them. And then lastly, reputational risk. When I mentioned the huge data breach and the unexpected outcomes that could come from that, that really was about reputational risk. So public disclosure of issues within the bank may limit the bank's valuation, may limit its ability to lend or borrow, and increase its regulatory oversight. So I don't want to belabor that. But now let's come into responding to risk. And this is where I'm going to answer that question on guarantees. So I'm going to use an example again, looking at the credit risk specifically associated with a commercial loan for the purchase of a multifamily property. So the bank is lending money to a property owner who wants to buy a small apartment building or a huge apartment building. It doesn't matter. It just differs in scale. And if we just lend them the money and hope for the best, then there's a pretty decent probability that we're not going to get it all back. It's very bad management. But there's some different things we can do. Depending on the kind of transaction, the kind of borrower, what we know about them, the property and what we know about that, we'll decide to do various different things. These are the terms that are most commonly used under the response. Remediation means removing or reducing at least the likelihood of a risk event. You usually can't remove the likelihood altogether. Although given the example I have here, you are actually removing the likelihood. So if you look at a particular transaction and say, I don't like this risk, and I'm not sure that other measures are going to do the trick, you basically turn it down. And that is the extreme remediation. But also you can do it by, for example, lending less, or digging deeper into financial stability, things like that. So you reduce the likelihood of default. The second thing is mitigation. You acknowledge the event may occur, but you look at how to reduce the impact if it does occur. That's where something like an SBA guarantee comes in. If you can make a loan that's guaranteed by the Small Business Administration, then you really don't have much risk at all. You do have some, but generally the SBA is underwriting the risk. The other thing you can do, though, is ensure you've got plenty of collateral. So in this particular case, if the multifamily property has a valuation, let's say, of $10 million, you might say you're only prepared to lend $6 million, a 60% loan to value ratio. If you really want to be conservative. Typical on that kind of property would be more like 80%. But you're not going to lend the 100% because one of the risks is that the value of the collateral goes down, of course, and a default occurs. The third thing you can do with risk is transfer it. You take out insurance. You sell the loan. Actually, you could argue an SBA guarantee is really a transfer rather than a mitigation, as I think about it. Because really what you're saying is the risk that we had, the SBA is going to take over from us. The whole insurance market really is about risk transfer, and banks use insurance. The fourth one is we can accept the risk. We can decide that this risk is within our credit risk appetite. And then we would price the loan to reflect our expected losses. So accepting the risk doesn't mean we're comfortable nothing will go wrong. It means we're comfortable that we understand what will go wrong, and we know what we would need to do with it, and we need to cover ourselves financially by putting that into the loan pricing. And pricing the loan means setting interest rates as well as upfront costs and servicing costs and that kind of thing. And then, hybrid, obviously in practice, you're doing multiple of these things. So personal guarantees plus, for example, an independent collateral valuation, which you would always do in this case anyway. Questions? Okay. And this is the last topic, enterprise risk management. And I said at the beginning I was going to talk about this. It's so much about how the whole bank views risk and manages risk. It's about risk culture. A part of a good risk culture says that every single employee understands that they are a risk manager. An employee is managing risk in how they manage their password, in whether they take sensitive documents home, whether they have personal email coming into their email account and so on. So even at that very low level, it's true. Every manager is a risk manager. And in fact, we talk about 3 lines of defense, and you see this in this diagram. The first line of defense is the line managers and all of the processes and controls they have in place. So underwriting of loans, payment procedures that require somebody to check somebody else's work if it's a big payment, those kinds of things. And they're all owned by the first line manager. And that first line of defense is absolutely critical and has to be managed. To be honest, managers should be performance managed based on how well they manage risk, as well as their overall operational or sales results or whatever it is. More and more that is the case. So at every level, not just the CEO, but at every level, the question about understanding of risk and management of risk should actually be part of the hiring process. The second line of defense has a number of specialist areas. Financial controls. So the financial controller overall is the second line of defense. Risk manager, information security, physical security. There is a risk management function, especially where specialists' needs around quantification of risk are found. Quality assurance of various different kinds. There are functions that will inspect processes and procedures and help lines of defense in arriving at stronger processes. And then the whole area of compliance, which is looking at regulatory risk, which is ensuring both the relationship with the regulators are good, but also that everything we do is in compliance with rules and regulations that we're subject to. And then the third line of defense is internal audit, which is an independent function. Internal audit reports to the board audit committee and really only nominally reports to senior management. It's really accountable to the audit committee. The audit committee has the legal accountability to ensure that risk is appropriately managed for the bank. And in fact, if they don't do their job properly, they carry some personal risk. Being on the audit committee, tends to have some financial remuneration to reflect that, and insurance and everything else. But that's a very important committee. The senior management, the C-suite, and potentially next level of management, descending on the size of the organization, is setting, basically laying out guidelines and policies that distribute the corporate risk appetite. The corporate risk appetite also is set by the board, and with the understanding and collaboration of senior management. Then senior management put that into practice. It's the way board senior management works in general. Policy or strategy really belongs to the board, but the senior management are the ones who actually carry it out. And then a holistic understanding of risk, how it's tracked and reported, and overall risk policy and procedures are all really important. They're all part of enterprise risk management and typically done in this second line of defense. So a lot of banks have a formal enterprise risk management function, in fact. So that's all the content that I was going to give you. Of course, there's lots more that could be. Do we have any more questions?
I have a quick question. Maybe it's because I'm a computer science teacher.
Mm-hmm.
I'm used to dealing with people who use mathematical formulas. I was surprised I didn't see a lot of formulas about how you add up all the risks across your enterprise and that kind of thing. I mean, maybe this is just not the right type of presentation, but are there known formulas, or people always just guessing?
No, you're absolutely right. Where risk can be quantified, it's actually a very complex process a lot of the time, and there are all sorts of computer models. As a matter of fact, one of the areas of compliance risk is known as model risk, because so much of what banks do is based on simple or complex or almost incomprehensible financial and mathematical models. And model risk comes from the fact that sometimes those models are actually not well understood. And so there's a new kind of risk that gets introduced. But you're right, quantification of risk is a key discipline. I intentionally didn't talk about it because it just gets too esoteric. But it is important to understand that some of this is very complex and some of it is very much computer driven and very much mathematical or financial modeling in nature. Thank you for asking that because it's important to understand that.
So where will we find people who would help us with this kind of work?
It's a it's a recruitment exercise like any other. There are they exist. They're out there. They're expensive. That's the only thing. What I will say though is that the risk profile for the public bank is going to be, relatively speaking, quite simple. It doesn't mean it has no complexity, but it does mean it's going to be easier to understand risk with a bank like this than it would be for a big commercial bank, for example.
So since we're new, though, I understand what you're saying, but since we're new, people might not necessarily know that. So is there, or need to be convinced of that. So is there something in our messaging when we talk to people, putting out in our literature, is there something that we need to be doing to say, we understand risks, we'll be good risk managers?
Yeah, absolutely. I think anyone you're going to ask for money from, and I'm including city and county treasurers or foundations or whatever. At least one of the key decision makers is going to very much understand the criticality of the bank being able to manage risk. And if you don't say that up front, then you're going to get grilled. So yes, I think messaging does need to include, it needs to reflect the fact that the bank is in the business of managing risk, and that we know there's a lot of things we have to do. I just put a couple of business plans together for huge Pan-African financial inclusion banks. I've mentioned that before. The risk management sections in those business plans and also in the investor decks are quite substantial.
We have another question. What's the normal default rate for a small bank?
I don't think there really is a normal rate. It depends on what kind of loans they're doing. Depends on the, I mean, it's just too many factors because, small banks differ enormously. They're focused on their immediate community, especially the smallest ones. And they're probably, you'll get banks that almost entirely do agricultural loans. They have a completely different risk profile to a bank that is doing working capital loans or doing construction loans or whatever. They tend to specialize differently. So I don't think there is a good answer to that. Typically you'll see default rates, though, I think in the single digit percentage. With some kinds of loans, it's going to be lower than that. And with some, it's higher, actually. But those are very, very highly priced loans, too.
Follow-up question is that default with 100% loss of principal?
Not necessarily. Number one, it depends on when the default occurs. So if you've got a loan in which principal is being paid back as well as interest, then the principal balance is going down. Not all loans are that way. But secondly, most loans are not unsecured entirely. The security might be a personal guarantee. It might be a business guarantee. It might be some collateral like real estate or equipment. So equipment, leasing loans, for example, are secured by the equipment that's being financed. And then some recoveries can be made by essentially, the term is perfecting the lien that you have on the collateral, which means it becomes yours. you have a lien on it, which gives you the right to take it in the default of the borrower, and then you can. Now, you run into some interesting ethical problems and some interesting social problems in some aspects of that as well. And of course, banks are not generally popular for foreclosing on people's houses because they can't afford to pay the mortgage. So that's something that the bank has to consider when it's pricing the loan. So yeah, it varies.
I have one question, Graham.
Yeah.
So the public bank, our model is always considered to be like a partnership bank. So the public bank would not primarily make loans itself to small businesses or housing, etc., but to other banks or CDFIs or credit unions. Do you have examples of other banks that primarily do this type of partnership banking that we could look at to learn how it works? And because I imagine that credit risk is different when you give loans to banks because they are regulated themselves. It's different than giving loans directly to people.
Yeah, the nearest equivalent I can think of, although they don't do a lot of lending, they do some, would be a banker's bank. And I've mentioned this in another meeting before. So our local example is Pacific Coast Bankers Bank, which is in Walnut Creek, headquartered in Walnut Creek. As it happens, I did some extensive consulting for them, so I know them quite well and know all the principals very well. A banker's bank only has banks as its clients. It has no businesses as clients. They have a few credit unions as well. But they still have to assess the credit worthiness of the banks if they're lending money or if they're doing any kind of transaction which puts them at risk, and it does at times. Community banks, there's been strings of failures of community banks, particularly smaller ones. Sometimes they'll get acquired. Usually that's what happens when they're failing. And usually the money will come back. You have to also consider the fact that if you have to foreclose, even a bank foreclosing on another bank, then they've got the expense and the time value of money for the delays for bankruptcy proceedings, which are most unpleasant. I've done a lot of them as a commercial lender, some more intangible losses. So yes, credit risk still exists. The parameters are going to be different.
Thank you.
The other thing, by the way, that a public bank may well be doing is offering guarantees rather than making loans. And what it's essentially doing is taking on the risk that the client bank has in making a loan to, for example, a low-income housing development or whatever it would be. So even though it may not be directly the risk of the original loan, actually indirectly, the risk has been transferred to the public bank. And we haven't really, I think, gone deep into the different kinds of lending models that we might have, but that's seems like a likely one.
We have another question. If loan payments are modified to help make it easier to pay back during hard times and it still gets fully paid off, but later, does this count as a loss or a successful loan?
Well, I think there's some subjectivity in that. In my mind, that's clearly a successful loan, and I think most banks would view it that way. There is perhaps some financial impact, though. So in a perfectly performing 5% loan that's $100,000 loan at 5% for 5 years, then the bank is going to receive interest payments of a total of $25,000. And there may be some fees as well. But in this case, they may not receive that full $25,000, or it may certainly take more than the 5 years to receive it, in which case the return on investment has gone down. So from that point of view, you could argue that it's less financially successful than a perfectly performing loan would be. I don't know that most banks would view it that way. And generally, there should be certainly an attempt to restructure loans, be they individual or business loans, if it looks like that will help with ultimate repayment.
Any other questions from the group?
You touched on it a little bit, but there's a subjective thing there. And, different board members will have different appetites and goals. And I particularly see that kind of tension in a public bank, where some will be more interested in profitable returns and others be more interested in the societal effect on the community.
Mm-hmm.
So could people even never agree on what is a risk and what even is the goal, right? So then I could see someone trying to do the math and be like, well, I thought we were in agreement on what the point is here. And so you want me to rework it, but you guys don't seem to even agree on what the point is. So how can I do the math?
Yeah, Kofi, I mean, that's a fabulous point. One of the biggest challenges is going to be, those conflicts of priority, not conflicts of interest, but conflicts of priority. I think to some degree, I think some forms of risk, common sense is going to prevail. So, credit risk, for example, you're going to manage in such a way that that you're not losing an unacceptable amount of money, and it's not going to be, it's not sustainable if you're losing more than you're making in credit risk. So some things will take care of themselves. But there are other kinds of risk. Reputational risk is a great example, where it could be really difficult to assess, what are we prepared to risk in order to make what might be a not entirely popular decision in any direction. And boards deal with that. If you have an experienced board who have you've done this before, who know what they're doing, understand compromises need to be made. I think part of the makeup of the board has to be a group of people who really do agree on the mission, even if they don't necessarily agree on how that mission should be carried out. And then they're prepared to work together to compromise, to arrive at the optimal solution that may not be perfect for anybody. It's like marriage or anything else in life, isn't it? But I do agree. I think it's a bit harder than it would be for your typical community bank.
Yeah, back to the bank financing. If let's see if I can word this correctly. So if we have the public bank being a partnership bank, it's when it gets the loans that it's going to, I guess, buy from them to help them capitalize, isn't it going to go through the underwriting also, or is it going to have to do the underwriting all over again?
If the public bank buys loans, then it will use the underwriting that was done by the originating bank, but it's also going to do some validation. So depending on how well we knew the bank we're buying loans from, if that's what we're doing, then we may or may not largely trust their underwriting. It depends on how transparent it is, but we're certainly going to review it. And then, yes, to some degree, we may want to do some more. For example, if we're not certain of the how recent or how independent valuations of collateral are, then we'll have them done again. So yes, the bank is still a lender in that situation.
Right. Okay. And so also about the string of bank failures, like why were they failing? Were they just like lending too much money and they were just too dumb to realize it? Or were they like one or two really big loans went bad, or just a string of loans, like they were just had bad underwriting? Or
yeah, it's been different things at different times, but Yes, if you look at 2008, largely it's because
One thing I was wondering, was there an external shock that just caused a bunch of them?
Well, yes, but banks got greedy. That's the thing. It wasn't entirely external shock. It was self-induced in a lot of ways.
They went speculative. Is that what you're saying?
So there was a bad balance between prime and subprime lending, for example, and over-optimism about the value of collateral. So some banks were making subprime loans in the expectations that they would default and that they could then foreclose on the house, because mostly this is just single family residential, and make money on it. And then laws changed so that they couldn't actually make that much money on it because they had to pay the excess back to the original borrower. But they didn't allow for the fact that property values actually were going to go down, and then suddenly people are underwater, and so foreclosing is an automatic loss. And there's a lot of cost associated with foreclosing and having to manage the property and then sell the property and everything else.
So it seems like a lot of, like, more I look into bank failures, it seems like it's either speculative or just straight up corruption, or like what you said, just there's ridiculous greed. Like if they just stuck with just regular lending and just regular credit and underwriting, like they would have been fine.
Yeah, and they continue to make modest profits.
Yeah, that's fine. It's like 20% or 15%. That's great, actually. It's like,
well, yeah. I mean, I think return on equity is
maximize profit.
I'm sorry?
It's great when you don't have to maximize profit.
Yes, it is. That's the thing. So shareholder pressure has a lot to do with it. And this isn't just banks. I had some dealings with CalPERS actually around the 2008 time. And if you may recall, they got into a great deal of trouble because they were making speculative investments. And yeah, I won't tell that story now, but they were a great example of pressure to improve returns, resulting in failure that drastically diminished returns. It's bad management. It's bad risk management. It's bowing to the wrong pressures. Sometimes banks fail simply because they're badly managed.
Right.
And they just aren't able to manage their expenses sufficiently that their income exceeds their expenses. It's a standard business failure. Sometimes it's cash flow, and liquidity is actually I didn't really talk about liquidity risk, but that's a significant form of risk for a bank, where you have to be very careful to match your cash inflows and your cash outflows in a way that doesn't leave you short of cash at some point in time. And that's happened to banks historically, and they failed because of it. Not often, but it happens. So there's a lot of different reasons. It's some form of poor risk management usually, and then poor overall management, and corruption certainly. Yeah.
These have all been really excellent questions. Do we have any final questions? It's 8:16. I just want to be mindful of people's evenings, but very great discussion so far. Any other questions? Okay, well, thank you so much, Graham, for another fantastic and very educational session. This has been certainly informative for myself, and I'm sure for others as well. And we have a few thank yous in the chat for you as well. Really looking forward to further developing our education as a group and having more of these sessions. Thank you so much for your time and your content as well.
Yeah, my pleasure. It's kind of a heavy subject, but thank you all for staying in. Great questions. I enjoyed it. Thank you.
Thank you.
Yeah, this was great. Hopefully we'll do another one. Let's talk about liquidity and cash flow. More details about Fed bank and settlements.
Right, borrowing to counter cash flow issues.
Yeah, I think at some point I'm going to have to do more work to get there, I think, but because I've been doing the stuff I know reasonably well so far. But there may be other people who can do it much better, actually, to be honest.
Do you know about capitalizing out of the box?
Capitalization it's one of our big challenges. Is you know, how we raise capital and what that looks like, because there are a number of different options and none of them are very good. But it's possible.
Okay.
All right.
Have
Great.
a good one. Thank you for joining.
Thanks, everybody.
Bye.
Bye.